Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. One step closer. The Senate passes a temporary funding bill that could end the 41-day government shutdown with a vote in the House set for Wednesday. Tariff relief. Switzerland is said to be close to a deal to slash US levies from 39% to 15%. We bring you our scoop. Plus, key UK labour market data due this morning when it discuss what it means for the Bank of England and its rate path ahead. Happy Tuesday. So it was a strong session overnight on Wall Street. Gains of more than 2% for the Nasdaq 100. Gains of around 1.5% for the S&P 500. And the European session was strong as well yesterday, led by banks, led by travel and leisure, with a closing price up of around 1.4% in terms of the gains coming through for European equities. Looking to build on that then in the session today, up 0.3%, certainly in terms of the movement and the Senate decision, the vote there to push through that bill, moving to the House, is a relief factor for these markets. The FTSE 100 futures pointed to gains of 51 points. We have data out later today in terms of wages, of course, and the jobless rate out of the UK at 7 a.m. UK time. S&P E-minis down a little bit by 0.1%. Nasdaq 100 futures off by 58 points, down 0.2%. Let's flip the board and have a look cross asset. Treasury's not trading right now. It's Veterans Day, so you do not get a print in terms of the US sovereign debt market. But on the euro, 115 right now on the single currency. The pound in focus ahead of that data that drops at 7 a.m. UK time. Markets now pricing in a 70% chance that the BOE goes with its next cut in December. We'll see what the data today does to support or undermine that view. 131 right now on the pound, a little softer versus the dollar by 0.1%. Gold up for a third straight day, above 4,100, gains of 0.3%. And Brent under a bit of pressure at $63 a barrel on Brent, down 0.6% so far in the session. So the record-setting 41-day US government shutdown may end as soon as Wednesday after the Senate passed a temporary funding measure backed by a group of 8 centrist Democrats. Bloomberg's Hong Kong news desk editor Balash Pence joins me now. Balash, bring us up to date then with the latest.
Yes, good morning, Tom. So as we heard, the Senate passed this resolution which will keep the U.S. government, most of the government, funded through January the 30th. And now this vote goes to the House, which scheduled a vote for Wednesday. And it's looking good for the Republican majority there. There was concern about some of the more conservative Republican members possibly not backing this bill, but the noises that they've made recently suggest that there could be a consensus among Republicans. They have a very thin majority, but it does look like they will be able to pass this bill, which then goes to President Trump's desk, who has already voiced support for this deal. So it does look like as soon as Wednesday U.S. time, we might get a final resolution to this shutdown. Now it will take a few more days until flights get back on track and until people get their payments, federal payments that they have been missing so far. But it does look like the end to this shutdown is finally in sight.
Yes, and maybe at a faster clip than some had expected. And to your point, the latest numbers on flights in the US, approximately 2,000 new flights being cancelled or delayed in the US. So the impact is significant there in terms of what's happening in terms of flights across the country. Meanwhile, Balash, what do we understand about? So, it was 8 Democrats signing the Republicans to get this through the Senate. Is there a price to be paid for the Democrats on this? They didn't get what they were asking for on health care. How deep are the divisions there, and what do we understand about the rationale of those Democrats?
Well, I think we only have to look at the reaction from Democratic leadership, both in Congress, but also from Democratic governors across the country. J.B. Pritzker and Gavin Newsom have been among the most vocal ones. They are furious at this deal. They felt like they were on the right side of this debate over the shutdown. The last week's off-year elections gave them the impression that the American people were behind them. A lot of them cited the shutdown and their stance on Obamacare subsidies as one of the reasons that the Democrats were able to do so well on these elections. And now, just a week later, we're back to the Democratic Party being fractured, finding it very difficult to show a united front and deliver a united message So the damage might be quite significant. They certainly look like the losers in this fight. As you said, they did not get what they asked for. They did not get what they bargained for. And the Republicans held firm and were able to hold the line in this shutdown fight.
OK, the Democrats looking like the losers in this fight, at least for now. Bloomberg's Hong Kong news desk editor, Balash Pence, thank you for that important update. Let's get to the market reaction to this then. A strong session, as we mentioned, on Wall Street yesterday, but futures fading right now. Let's bring in Bloomberg's Valerie Teitel on the market reaction. Val, what's happening?
Look, the rally does look a bit more fragile in the overnight session in Asia. It was a weak handover from the Asia session. Those NASDAQ futures retracing around 0.25%. But we need to put this move into context. Yesterday's rally was quite decent. The NASDAQ actually having its best session, Tom, in 5 months, up some 2.2%. Nvidia was up nearly 6% in yesterday's session, its best session since the Liberation Day volatility of early April. So definitely a strong session for the equity markets. So I'm not sure how much we can read through in the weakness this morning. Maybe not surprising. We see some sort of pullback. But I also want to mention some technical factors here. Flip the board. I want to talk about how we had both the S&P 500 and the NASDAQ bouncing very strongly from their 50-day moving average. Now, on Friday's session last week, the S&P 500 dipped below the 50-day moving average for the first time actually since April, since that tariff-induced chaos back in April. But we have bounced well above it now because of yesterday's strong session. So perhaps you can argue this positive test of momentum is looking good for the way forward. But watch out, if we do get this reopening of the U.S. government on Wednesday, we could see that non-farm payroll print that really delayed September print coming on Friday. Perhaps that could shift the momentum in the equity market. I also want to mention the momentum in gold. We've seen gold notch one of its best sessions of the year yesterday, Tom. It was up nearly 3%, best session in 6 months. And a lot of this can be tied to the liquidity story around the government shutdown. Now, since the shutdown happened, the U.S. Treasury has paused a lot of its payments. So the checking account of the U.S. Treasury, also known as the TGA, the Treasury General Account, those cash balances have been building up. But now the shutdown looks like it's paved the way to be over. Those payments will be resuming. That return of liquidity to the U.S. economy is a positive for gold. So one of the main momentum factors dragging gold price higher yet again overnight. OK, Bloomberg's Valerie Teitel, thank you very much indeed with the market update there. Let's get to the scoop around the trade story. Some positive momentum there, particularly if you're sitting in Switzerland, because Bloomberg understands that Switzerland is close to securing a 15% tariff on its exports to the US. The deal, which may be concluded within the next 2 weeks, would of course be a relief after Switzerland was hit with a punishing 39% levy back in August. For more on this, let's bring in Bloomberg's chief Asia correspondent, Ros Mattison. Ros, what do we know then about this potential deal between the Swiss and the US?
Well, as you were saying, our reporting shows that the Swiss are optimistic they'll get this rate down to 15%, which would bring it into line with the EU, and obviously a significant amount of relief there for the Swiss. Donald Trump was asked about it. He said that he thinks there also might be a deal before too long, but he wasn't drawn on that essential figure of 15%. What we know is the Swiss have been mounting essentially a charm offensive. Only a week ago or so, a bunch of Swiss billionaires and senior executives met with Donald Trump in the Oval Office. That seems to have worked some magic. Obviously, the Swiss have also been trying to find ways to show Donald Trump they're hearing him on his concern about the imbalance around goods, in particular between the US and Switzerland, and possibly, some investment in the gold sector for the US, because it's really the gold sector that Donald Trump seems to be fixated on. And can they offer some investment on gold refining in the US to try and ease that imbalance? So at least some optimism that after months, so you say the shock of that 39% figure is still very real, that perhaps we are getting towards something that would bring the Swiss more into line with the EU.
We also have some developments, it seems, Ros, when it comes to India and US trade relationships. The President Trump, of course, saying that the US was getting, quote, pretty close to a trade deal with India. He has said that before. What do we know about conversations between those two sides?
Well, that's right. He has said this before, but he has said again, as you were noting, that he feels that they're getting closer. He says they don't love him at the moment, but they certainly will at some point. He didn't give any great specifics around those comments, but we do know that there are also cautious noises of optimism coming from the India side, we know there have been lots of negotiations going on in recent weeks, and that's to try and get this relationship back on track after a number of setbacks. Obviously, India was upset about the way that Donald Trump cast his role, or his perceived role, in getting a ceasefire between India and Pakistan after their skirmishes. He was also, slapped India with these extra penalties because he said they were buying too much Russian oil, when, of course, lots of countries are doing that. But India has been taking steps since those Russian entities were sanctioned to purchase their energy from elsewhere. So perhaps that's also easing tensions in the relationship. So there's still, a lot of steps to go on the US-India side. There's still a lack of clarity around some specific measures that would come into play in this trade deal. But the mood music, at least between both sides now, does seem to be more upbeat.
Ros Mattison, Bloomberg's chief Asia correspondent, on the movements around potential deals between the US and India and Switzerland as well with the Bloomberg Scoop. Ros, thank you very much indeed. Talking of Asia, let's cross over right now to Winnie Su in Hong Kong with a check on the Asia markets. Winnie, what is standing out to you today?
Yeah, morning, Tom. It was a bit of a relief earlier in the day when we were talking about the end to the U.S. government shutdown. However, you can see that Asian stocks actually got weaker later in the afternoon, and that is driven by a couple of things. Some concerns around how the end of this month-long data blackout might mean that we're going to get some fresh surprise from the U.S. data to come up, and also the latest headwind being this report from Wall Street Journal talking about how China is preparing some plans to restrict rare earth access for U.S. military. So that's weighing on the overall risk sentiment as investors consider how the durability is really for the two countries in terms of this trade truce that we're seeing right now. And overall, benchmark-wise, you're seeing the Hang Seng and also the Taiwanese benchmark slightly lower, while the Kospi is still gaining some ground. Now, take a look at the next chart, because take a look at the next board, because we are also focusing a lot on the Japanese market because earnings is pretty much under the spotlight here. Overall, still quite mixed, dragged down by the overall sentiment. But Sony here rising 5% or so after the company lifted its profit outlook, and also saying that the tariff impact was smaller than expected. We are also waiting for SoftBank to announce its earnings in about 20 minutes time or so. And it is quite a big focus just because how far it has rallied this year, 140% gains so far this year on that AI rally. Now, take a look at the Chinese assets, and we flipped the board because, like we just said, a lot of pressure there when it comes to the U.S.-China sentiment, but also just overall domestic consumption has been quite weak, and some of the pressure when it comes to how the macro picture is looking for the country. However, one stock that really stands out is XPeng here, rising 16% or so on the optimism around how the company now has more technological advancement into the humanoid robots and transforming away from just being a traditional EV maker. Back to you, Tom.
Winnie Su, thank you very much indeed. A very strong day, as you said, for XPeng on the back of that details. Humanoid robots and the potential for that company. Here's what else to think about today then. 6:30 a.m. UK time. As Winnie mentioned, we will be breaking. We expect SoftBank Group earnings, that company's stock price up, as you can see, more than 145% year to date. And at 7 a.m. UK time, important data out of the UK on employment, jobs and wages, as investors increasingly bet on a December cut from the BOE after they held, of course, earlier this month. And at 10 a.m. UK time, we'll switch focus to Germany with the ZEW survey, expectations dropping at 10. You can get a roundup of the stories you need to know, of course, to get your day going in today's edition of Daybreak. Terminal subscribers can go to Go, and, of course, unpicking the Senate's vote passing that spending bill and the prospects of the shutdown ending as soon as Wednesday in the US. Coming up, the Ukrainian drone industry and its push into European markets. We'll be speaking exclusively with the international CEO of Skyeton, one of the companies at the forefront of that push. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, since Vladimir Putin's invasion, the need to develop and fund weapons has pushed Ukraine to become a drone superpower. Now, as Europe is confronted with a wave of airspace violations, Ukrainian companies are looking towards European markets. Skyeton is a Ukrainian unmanned aircraft system firm with nearly 2 decades of experience developing and supplying drones for commercial, industrial and military use. Joining us now is Pavlo Shevchuk, International CEO at Skyeton. Pavlo, thank you for joining us. How has the experience, hard-earned, of course, in Ukraine, filtered and tied in to demand in Europe at a time, of course, of those incursions? What are you seeing from European partners? How much demand, how much opportunity potentially is there for a firm like yours?
Thanks for inviting me. Well, to start with, Ukraine is definitely very unique in adapting and scaling up the new technologies in the battlefield. Obviously, with the war conditions, we were forced to do so. And having this experience and having the technology adopted and improved over the last more than 3.5 years of war, we definitely can offer something unique to strengthen the European defense system. And Europe represents, obviously, a very strong defense industrial base and supply chain. It's safe also. So we are really looking into bringing our production and localizing into Europe with the purpose to strengthen and support European defense initiatives. That's our aim. That's what we are doing.
Yeah.
And with this, we established a number of partnerships already in Europe.
And certainly in terms of the fiscal spending, particularly coming through from Germany, where you're sitting right now, and the rhetoric from European leaders is all pointing in the right direction if you want to see that European sovereign defence capability built up. Are you seeing that really, though, translated on the ground? Are NATO members, are European countries actually acting and implementing? Are they signing orders with you and others?
Well, they are starting to do so. Obviously, initiative is very high scale in terms of increased spend and increased ambition to defend and build up Europe's sovereign defense capability and sovereign supply chain. It takes time to process it in a system which used to be, over the years, quite heavy in the procurement, quite heavy in the design, and quite slow in adoption. But that's changing. We see it already now with a number of innovation centers set up in Germany and other countries, supporting the armed forces and really trying to speed up the adoption, procurement, and then obviously scaling up production in Europe. So that's changing, changing in the right direction.
When we think about supply chains and a moment when there's a focus on rare earths, particularly rare earths out of China, how vulnerable, Pavlo, are your supply chains to China? To what extent have you been able to focus on domestic supply chains to build out resilience?
Well, that's a very good question. The whole world is very much dependent on Chinese supply chain and Chinese components, electronic components. And that's changing, both in Europe and in America. It takes time, obviously. We need to take this time now while scaling up production of electronic components in Europe, that all the defense producers review their bill of materials and really make it China-free. We are part of this initiative. We are doing this. Today, I mean, I'm speaking on the phone with you. A lot of equipment in your studio, they all have Chinese components, obviously. So that's unavoidable today, but obviously that will change pretty soon. We are talking about, years, 2, 3, but then by this time, Europe needs to have its sovereign supply.
Europe needs to have its sovereign supply. Pavlo, very quickly before we let you go, is Ukraine winning the drone war at this point?
We are winning the war, and we are defending our country. We are saving the lives, and we are protecting our troops. And that's the mission which Skyeton has in mind. That's what we have in our heart. We will win. We will prevail.
Okay, Pavlo Shevchuk, thank you very much indeed. International CEO at Skyeton, the Ukrainian drone maker, of course, based right now, at least, joining us from Munich, Germany. Don't miss our next edition of Bloomberg Tech Europe, by the way. We will be discussing and focusing on the defence space and how AI is reshaping that industry. It all starts this Friday, 6:30 a.m. UK time. Then you can find it on YouTube and, of course, across social media as well. Coming up, doubling down on China. Switching focus to the luxury space. Louis Vuitton, Dior and Tiffany, the LVMH brands, all said to be planning to open new stores in Beijing next month. We discuss if the luxury slowdown in the world's second largest economy is finally coming to an end. What does it all signal? That's coming up. This is Bloomberg. LVMH is ramping up in China, with the world's biggest luxury group said to open 4 flagship stores in Beijing next month. We're joined now by Bloomberg's Shirley Zhao in Hong Kong. Shirley, how significant then is this new wave of store openings for LVMH and its China strategy at a time when we're thinking about deflation in China, a pretty weak consumer, a housing market that has certainly not recovered? What is driving the shift back towards luxury spending, if indeed we are seeing that?
Right. So the scale of the new store openings is certainly significant because we're talking about 4 major LVMH brands, including Louis Vuitton, Dior, Tiffany, and Loro Piana. And they're all opening multi-story, massive stores in Beijing next month at the same time. And that scale is rarely seen in recent years in China. And LVMH is still discussing with Swire Properties about opening a new Dior store in Shanghai as early as 2027. So these all highlight luxury giants' strategy in recent years in China in building these massive destinations that provide unique shopping experiences, such as food and drinks and exhibitions, to lure wealthy Chinese shoppers. Chinese consumers used to be all about brand names, but now their shopping behavior has changed, and they're seeking more personal wellness and experiences. And what these luxury brands are doing are building connections with Chinese consumers on a personal level. This shift in more spending in luxury that we've observed recently partly is driven by these luxury brands' effort in building these destinations. The latest Louis Vuitton flagship store in Shanghai, for example, has driven a lot of visitors since its opening in late June. And in the third quarter this year, the shopping mall where the Louis Vuitton store is located saw its sales double. So we've definitely seen signs of a recovery in Chinese luxury scene. And also the stock markets in mainland China and Hong Kong this year have performed relatively well. And I think that might have contributed to more spending in the luxury category.
OK, Shirley, thank you very much indeed on the expansion plans of LVMH and some of its brands into the Chinese market. Bloomberg's Shirley Zhao in Hong Kong. Coming up, a looser labour market adds another woe for the UK's Labour Party. We will preview the jobs data today to see if it confirms that. That is coming up. This is Bloomberg. Good Tuesday morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. One step closer, the Senate passes a temporary funding bill that could end the 41-day government shutdown, with a vote in the House set for Wednesday. Tariff relief. Switzerland is said to be close to a deal to slash US levies from 39% to 15%. We're going to bring you our scoop. Plus, key UK labour market data due this morning. I want to discuss what it means for the Bank of England and its rate path ahead. Let's bring you the earnings story, though, from SoftBank right now. The stock is up around 145% year to date. The top lines, of course, expected to come through with a third straight quarter of profit. Second quarter net income coming in at 2.5 trillion yen, well above the estimates of just shy and just below 500 billion yen. SoftBank will conduct a 4-for-1 stock split effective January the 1st. That is a redhead across the terminal right now. SoftBank to conduct a 4-for-1 stock split effective January the 1st. Second quarter net sales beating estimates. In terms of first half net sales, 3.74 trillion yen. Second quarter net sales coming in above the estimates, 1.9 trillion yen, above the estimates of 1.89 trillion. First half net income, 2.92 trillion yen. They got a second quarter dividend of 22 yen. And again, in terms of second quarter net income, 2.5 trillion yen. The estimates had been for around 420 billion yen. So beating handily when it comes to net income in the second quarter. But the redhead is focused on the stock split, 4-for-1, effective January the 1st, benefiting, of course, SoftBank from the AI momentum, particularly with names in its portfolio, including, of course, ARM Holdings, that has performed very well year to date as well. SoftBank has about a 90% share in that company. Let's get to the broader markets right now. Yes, earnings are part of the factor, but also, of course, the movements in Washington to resolve this long-running government shutdown, with a bill passing the Senate, now heading to the House, and that could be resolved, as mentioned, as soon as Wednesday. A very strong session on Wall Street yesterday, reflecting the optimism on the politics then, with the Nasdaq up more than 2%, the S&P closing high by 1.5%. European futures pointing to gains, looking to build on the upside of yesterday, up 0.4%. FTSE 100 futures looking to add 57 points. We have important UK data out at 7 a.m. UK time, little under half an hour, of course. S&P evenly is currently flat. Nasdaq 100 futures also largely unchanged. Let's split the board and have a look cross assets. We don't have a print on treasuries. It is Veterans Day stateside. So the focus on the currency space, gold and oil. Euro dollar at 115, the pound at 131. We'll see how choppy that is around the UK data. Gold back above 4,100. 3 straight days of gains for the yellow metal, performing very strongly in recent days, up 0.4%. And Brent under a little pressure on oil, down 0.4% at $63.83 per barrel. Let's get to the macro right now, because we have been speaking exclusively to San Francisco Fed President Mary Daly and St. Louis Fed President Alberto Musalem, who gave us diverging takes on what the Federal Reserve should do next.
We also see a labor market that's softening and wage growth that is moderating. So you're really not going to see a lot of pressure coming on the cost side of labor. So I put those things together, and we don't want to make the mistake of holding on too long for rates, only to find out we injure the economy.
It's very important that we tread with caution here. I think there is limited room to ease policy further without policy becoming overly accommodative.
For more, let's bring in Bloomberg M-Life strategist Mark Cranfield. Mark, where are the markets leaning then? Are they leaning to the Mary Daly take that we have to be a little bit careful about staying on hold for too long, given the softness in the labour market, or to other views, Musalem included, around the potential inflationary pressures?
Well, the way traders are pricing the market at the moment, they're still more inclined to go with Mary Daly. So the odds are not as high as they were for a 25 basis points cut in December, but it's still more than 50%. We're tracking somewhere around 60 to 65% odds of an interest rate cut in December. That's moving around all the time. But for the moment, people in the market are generally thinking that by the time we get to that December vote, more people would have come on side, and eventually the Fed will go with it. Now, don't forget, the Fed is very split. Some people have even been comparing it to the Bank of England. We had a very unusual three-way split at the previous meeting where somebody wanted 50 basis points, they went for 25, and some people didn't want anything at all. The chances are we'll get something close to that again, because we can still see there's a wide divergence of views, as your sound bites there suggested, and more people within the FOMC are similarly disposed to that. But once this shutdown is out of the way, the pressure is likely to come back onto the Federal Reserve. They will be the centre of attention, and you can expect there will be a lot of significant voices from outside the Federal Reserve pushing them towards doing something, because during this shutdown period, that's hurting the US economy. We're probably going to see more data to justify that the employment situation certainly didn't get any better. It was already deteriorating before the shutdown. And so the chances are that the voices will be calling for the Federal Reserve to do more to make sure that the US economy doesn't go into retreat in the fourth quarter, because some private economists are already suggesting it could be a negative number in the fourth quarter. Now, nobody would want to see that, so you can imagine that the Federal Reserve will be aware of that, and traders will be looking for them to do what they can. So the chances are, by the time we get to that December meeting, 25 basis points will still be the likely thing that people expect in terms of a rate cut, and it's hard to see any divergence from that. If anything, it's more likely to swing towards a bigger cut rather than a smaller or no cut at all.
Well, tie that then into the market views around the US dollar, Mark, and particularly some number crunching that the Bloomberg team have been doing around the carry trade and what it's meant in terms of the greenback and appetite for exposure to the dollar.
Certainly in isolation, when you have US short-term interest rates around 4%, which within the G10 complex is really pretty high, and particularly against their two main rivals. So when you're thinking about the US dollar against major currencies, really the two big ones obviously are the euro and the Japanese yen. Clearly, short-term yields on the US are generous compared to those. But if you look at the year-to-date performance overall, euro's still up more than 10%. The Bloomberg Dollar Spot Index is still down around 7%, even though it's rebounded slightly recently. The key to all of this, really, is the change from the other side of the coin. We know what's happening in the US. We know where the Federal Reserve is. We know where rates are heading there. What we really want more information on is what's going to happen in Europe and in Japan. If the European Central Bank starts to sound a little bit more hawkish, if they talk about the need in 2026, maybe even to raise interest rates, that will change the dynamics completely. For now, ECB is on hold, happily doing so. They could be on hold for quite a long period of time. The Bank of Japan has been very, very slow to raise interest rates. It's not even certain that they will raise them in December. So for the time being, the US dollar doesn't really have any strong competitors. It's pretty much on its own. The euro and the yen are on the back foot. Should that change at any time, the whole dynamics of the carry trade will be turned upside down, and it won't look nearly as interesting as it does right now.
OK, well, that's a word of warning. The carry trade has some momentum, maybe, but we'll watch for changes and any adjustments on the data front and the reaction function of the ECB and the BOJ. MLive strategist Mark Cranfield, excellent as always. Thank you. Let's get to the UK story in more detail right now, because UK retail sales growth weakened last month as shoppers held back ahead of the government's upcoming budget in anticipation of Black Friday deals. According to the British Retail Consortium, total retail sales rose 1.6% from a year earlier in October. That's the slowest growth since May. The slowdown was driven by non-food, with essentially no growth in sales of toys, electronics and clothing. The latest UK jobs data, meanwhile, is said to be released later today, so a focus on jobs. And that's likely to continue to paint a picture of a loosening labour market here in the UK. Bloomberg Economics forecast private sector pay growth fell to 4.2% in the 3 months to September. It comes ahead, of course, of, have we mentioned the budget yet? The budget on November the 26th. For more on this, let's bring in Lizzie Burden, our UK correspondent. What are you looking for then, Lizzie? Good morning. In the data out later today, 7 a.m. UK time.
Yeah, good morning, Tom. Well, this is crucial for the Bank of England, this data set. And as Mark Cranfield was just reminding us, the Bank of England is really split at the moment. At the last decision, it was a 5-4 split, so really on a knife edge. They went for a hold in the end. And the hawks on the committee are worried that you're going to have upward pressure on pay growth because of sticky inflation. So we watch these numbers. As you say, economists are expecting a moderation in wage pressure, unemployment to have ticked up from 4.8% to 4.9%. And the more the job market loosens, the more likely a December cut is. Though, as ever, we take the labour force survey with a pinch of salt, given all the recent data collection issues. Notably, Investec overnight changed its view from a hold to a cut for December for the BOE. But of course, as you say, we're still waiting to see what's in that budget. And we've got 2 more CPI inflation prints before the December meeting.
To what extent is the budget a fait accompli at this point? Or does the data today potentially change the thinking of the Chancellor?
Yeah, this is going to feed in. You heard the Chancellor in her speech last Tuesday, that impromptu pre-budget speech. It sounded to many analysts like her main target audience was the Bank of England. She wants a rate cut from them. And the trouble is that her tax rises at the last budget, last autumn, have contributed to inflation in the UK and its stickiness. Now, in a BBC interview yesterday, she made her strongest hint yet that actually she's going to go for tax rises over spending cuts at the budget, even if it means breaking her manifesto. She's already put her plans to the fiscal watchdog, the Office for Budget Responsibility. The Times of London newspaper reported that those plans included increasing income tax, which would break the manifesto, but she's yet to finalise exactly what she's doing because, as you say, she's still watching all of this data. But already that is facing criticism. And as you say, already consumers have been holding back on shopping in anticipation of tax rises.
OK, Lizzie Burden, UK correspondent, thank you very much indeed. We look ahead to that data dropping in a little under 20 minutes, wages and jobs, with markets expecting and pricing in a 70% chance that the BOE goes with its next cut in December. Now to some of the stories making the news this Tuesday. Bloomberg understands the EU is exploring ways to force member states, to phase out China's Huawei and ZTE from telecoms networks. Sources say the European Commission wants to convert its 2020 recommendation to stop using high-risk vendors in mobile networks into a legal requirement. The EU is increasingly focused on the risks posed by Chinese telecom equipment makers as trade and political ties with its second-largest trading partner, Frey. Russia's Lukoil has declared force majeure on oil shipments from one of its oil fields in Iraq. The move suggests that sanctions against Russia's second biggest oil producer are beginning to impact its international operations. Iraq's state oil marketing company, SOMO, has now cancelled 3 Lukoil cargoes for November loading following the announcement of those sanctions. Let's give you some breaking news right now on SoftBank and its ties to Nvidia. SoftBank Group sold its Nvidia stake for $5.8 billion. SoftBank updating investors, saying it sold its stake in Nvidia in October. That is a stake that it sold for $5.8 billion US. We'll try to get more information on this, of course. SoftBank has been a major investor in Nvidia, of course, historically. It is also, of course, a major investor in ARM as well, with a 90% holding there. But obviously, this is consequential. And, of course, given the run-up in Nvidia's share price, will have paid off, of course, no doubt, for SoftBank. But interesting that it's deciding to sell and has decided to sell that stake back in October for close to $6 billion US, $5.83 billion US. That's the update on SoftBank on the back of its earnings, of course, where it went for a stock split as well, 4-for-1. Coming up, as the UK's financial services sector rapidly adopts AI solutions, what is the outlook then for jobs in the industry? We'll be speaking to the CEO and co-founder of FloQast. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the UK's financial services sector is rapidly adopting AI solutions. So how is all of that impacting jobs? And what does it mean for the broader economy? Let's bring in Mike Whitmire, CEO and co-founder of FloQast. It's an AI accounting platform that's raised $300 million to date, with headquarters in Los Angeles, but a significant operation and footprint here in the UK. Mike, thank you for coming in. What exactly are you guys doing that changes the world of accountancy? What is AI able to do within that sector?
Yeah, well, thank you for having me. I really appreciate it. Let me just take a step back. I'll say, for starters, my background is in accounting, so I've lived the job. I've done it before. And FloQast was founded about 10 years ago at this point. So we started as very classic SaaS workflow application. We help accountants with the month-end close reconciliation process, which feeds into reporting. So we've done really well. We have thousands of customers using that solution. And then AI hits the scenes, and there's a lot of opportunity with it, but I think a lot of confusion and kind of, quite frankly, fear around what's AI going to do to jobs and how's it going to impact work and everything. And at FloQast, being by accountants for accountants, we think there's a really fascinating opportunity to leverage AI to empower accountants to automate some of their own work. So from my perspective, it's not necessarily about automating accountants wholesale. It's about empowering them to automate some of the boring work that I did back in the day when I was doing the job, and really shifting the role to be a little bit more like a technologist and less like a number cruncher or a bean counter.
So a lot of my guests, whether it's in legal or banking, they make the same case. But we're empowering our employees.
Yeah.
And I have to raise an eyebrow. Really? I mean, how long does that continue, Mike? At what point does the technology that you use and deploy actually start taking over the roles of accountants, particularly junior accountants?
Yeah, so that's an excellent question, very fair. I would say when I look at legal versus some other industries, believe it or not, accounting, while from an outsider's perspective, it feels very standardized and the same everywhere. The reality is when you do the job, because of the uniqueness and complexity of every different company, there are a lot of things specific to that given business. And so wholesale automating accounting is actually much more challenging than you would ever expect. So it's about giving accountants those tools to automate that work. Now, on the legal side, I can use AI to draft an entire contract for me. That's kind of fine. That's no problem. If you get into the guts of an accounting department, it's not quite as simple as drafting a contract. And so I do think you're right to say at the junior level, there's probably a little bit more automation. I will say in the United States, we're currently dealing with a talent gap issue anyway. We have fewer we have fewer accountants entering the profession. So in some ways, we need technology to automate some of these jobs and then close that talent gap as it continues to accelerate. So I don't think you're wrong. However, I think within accounting, it's a big opportunity to shift the role.
Are you model agnostic? What models are you using that you plug into your system?
So we are model agnostic. We started with your classic ChatGPT, and then we've expanded the models that are.
How much competition are you facing from the large language models and others in this space, and how defensible is it?
Yeah, so there so a ton of models out there. A lot of them are trying to automate workflows. What's unique about accounting as it relates to other functions within a company is accounting has a lot of regulation to deal with, particularly around financial statement audits. And my background's also in audit, and so when I look at how technology is being used in an accounting department, it always has to be auditable. And if you're an OpenAI or an Anthropic or one of the others, you look at all the opportunity across business and perhaps not going into the sector where it's very regulatory, you could pass or fail audits. That's an important one to stay away from, and that's what we specialize in.
Okay, so you've raised $300 million. Some of your customers include Jaguar, Halfords, Joe and the Juice. How much growth are you seeing? You're an accountant. Can you give us some numbers in terms of the pace of growth that you guys are seeing?
Yeah, we're adding hundreds of accounts every quarter. Our contract values continue to go up. We have happy customers who are renewing and purchasing more solutions.
Can you give us ARR, annual recurring revenue?
I'm not going to. I'll say we're passing 200 million there, so around that scale.
You're currently passing 200 million annual recurring revenue.
We'll be there very shortly, and it's been a healthy growth rate.
That's a this year number for you guys. IPO, I mean, the most recent raise was an E round, so you're getting closer to a public listing, presumably.
Yeah, we're getting closer. It's my personal goal as a founder of the company. I want to run a public company. We're at a point where if we chose to, we could go ahead and start to execute on that. However, we think there's a lot of opportunity in terms of further international expansion, investment in product, investment in building up our go-to-market enterprise. And so there's just a lot of opportunity. And for me, I don't think right now is the best timing for us. So it's more about what's the timing of the business.
When the timing aligns, what is the most obvious location to list?
We would do either the New York Stock Exchange or NASDAQ, being headquartered out of the United States.
London doesn't even get a look in, does it?
No, not quite. It's the very common ones for us would be the big two in the United States. Yeah.
Okay, Mike, thank you very much indeed. Really good to get an update from you in terms of how AI is changing accountancy and what it all means, of course, for those working in the space and a potential public listing at some point in the future. Mike Whitmire, CEO and co-founder of FloQast. Thank you. Sticking with tech, CoreWeave shares dropped in after-hours trading after it reported narrower profit margins in the third quarter and cut its forecast. The firm is part of a group of companies known as NeoClouds, which rent out access to powerful AI chips. The disappointing earnings report marks a setback for CoreWeave, which is racing to keep up with the AI boom. And Warren Buffett says he is going quiet, marking the end of an era for one of the world's most watched investors. In a letter, the Berkshire Hathaway CEO, who is stepping down from the role at the end of this year, says he will stop writing the firm's annual letters and speaking at its meetings. The 95-year-old billionaire also says he will give more than $1.3 billion to his family foundations and plans to accelerate donations while he's alive. Plenty more coming up. This is Bloomberg.
Basically, we have the worst consumer sentiment about current economic conditions, basically ever. worse than, not just worse than the 2022 when we had 9% inflation, but worse than the aftermath of the financial crisis, worse than the stagflation of 1980. People are really, really down on this economy, and I have to say I don't think that the way this drama has been playing out is going to change that.
Okay, Nobel laureate Paul Krugman speaking there on the health of the US economy. More data expected, of course, if we get an ending to this shutdown. And certainly a big step taken in terms of the Senate vote on that bill. The government then in the US could reopen as soon as Wednesday. At least that bill could be on the president's desk and signed and sealed by Wednesday if it moves through the House at a rapid pace. For whoever said the markets don't care about the shutdown, here's evidence that, in fact, it does. Certainly the ending of the shutdown, you saw that lift. The S&P 500 back above its 50-day moving average, and pretty comfortably so as well, at 6,832 by the close yesterday. The gains of more than 1% for the S&P 500, 1.5% by the end of the close. The Nasdaq 100 performing even better yesterday with gains of 2.2%. Today, futures pointing to US markets looking a little bit for clearer direction. In terms of what happens with the US dollar when more of this data comes out, let's flip the board and have a little bit look at what is happening in terms of the deep dive that Bloomberg's done on the carry trade. And of course, the data that comes out on the back of the reopening of the US government, when that happens, will tie into this and Fed expectations, of course. But Bloomberg has been crunching the numbers on this, and the carry trade involving the US dollar, so borrowing cheaply, of course, in low yielding currencies like the Swissy and the yen, and piling that into a 4% US dollar, has proved successful, and it pushes back on the Sell America theme. At least it does for now. And of course, any changes from the ECB or the BOJ could change that momentum. But the data that we've been looking at suggests that it is one of the best performing trades, at least in the last few months. The dollar has come back. Year to date, of course, the Bloomberg Dollar Index is down. But at least recently, that momentum and that mood has changed. Let's get a check on the UK data. It's coming up in just a couple of minutes' time. The opening trade team will break this down for you, of course, with markets pricing in now 7% chance that BOE goes with its cut in December. So the focus on wages, the focus, of course, in terms of the unemployment rate. We have the budget, of course, November the 26th. The expectation is the estimates on weekly earnings, 5%. It's the weekly earnings ex bonuses that will be in focus, 4.6%. Any softening of that will, of course, build out those views on the BOE and December. To access and search all of these, of course, go to the Bloomberg terminal. We have some breaking lines on SoftBank and its partnership around Nvidia. Hope to get those for you shortly, of course. We know that it has sold its stake worth close to $6 billion US. So the SoftBank story in focus. Plenty more coming up. The open trade is next. This is Bloomberg.